YouTube family, Stocks with Josh here. Well, the number one question that all of us are asking ourselves going into this next week of trading is it safe to re-enter these markets? Well, the smart money over at Credit Suisse is identified a number of indicators to their investors as to when they will begin to put money back to work and begin to buy stocks. We are obviously in a recession. We're in a recession here in the US and Europe as well as China. So why should anybody be buying stocks when company earnings are very likely going to be falling in the days ahead? We are definitely going lower. Europe is dealing with soaring energy costs, which is basically damaging their ability to do commerce, to do business, to build products. The cost of energy is making everything more difficult in Europe's economy. And so we know that the profit of their companies is going to be dramatically falling. There are many leading indicators in the US that we keep an eye on to know whether our economy is going to be following and how far it's going to be following. I'm just going to begin to throw out some of them and explain what those indicators are. One of them is called the Manufacturing New Orders Report. The Manufacturing New Orders Report basically is for companies like Boeing and Caterpillar and a lot of manufacturers, and they're going to tell us from cycle to cycle whether or not the new orders that they're getting for products is going down or increasing. And we don't have to get back to the place where it's at an all-time high. We just need to see from the manufacturing report that there's a pivot. We need to see that pivot. We need to see that we might have dropped, but then we're slowly beginning to build again, and that's when money will pile back in to stocks. Another indicator that is being looked at is consumer confidence as well as business confidence, because the bottom line is that people are not going to be spending. The consumer will not be spending and buying goods. If they've got fears about a recession, they'll be saving their money, and businesses will not be hiring and investing and growing the business. And you got to remember that the value of stocks is determined by growth. Stocks are always forward looking, and so we always want to see higher and higher profits coming from companies. Otherwise, stocks prices will be falling. And another indicator that is being looked at is the price of copper. Price of copper is actually a huge leading indicator for our economy, and basically that's because copper is in everything. It's in new houses as well as all sorts of products, and electronics has copper in it. And when the price of copper is going up, it's because the demand of copper is high, it's because it's being used, and it's a very good indicator as to the fact that companies are going to be selling more goods because they're manufacturing more goods. But when the price of copper is falling, it means that there's lower demand, which means there's lower manufacturing, which means that the economy is suffering. All of these are leading indicators, and they show when the economy is strong and growing. And we just have to address the fact that the Fed cutting rates does not fix or address a recession at all. Cutting rates is entirely for taming inflation. Now, a recession can actually tame inflation on its own most of the time, but there's a lot of inflation that recessions cannot fix, and that's the type of inflation that comes through supply chain issues. We see those being affected by China going into political turmoil, or the war between the Ukraine and Russia are affecting the supply chain issue, which is causing products to go up, which the Fed cannot touch or resolve or address with its rate hike increases. At the end of the day, the smart money knows that it's the PE ratio that we need to be looking at. And they're expecting a pretty long cycle of downward revisions due to a lower earnings ratio revision. Stock prices rose very heavily over the last decade because they were largely seeing record-breaking profit margins. Stock prices rose heavily over the last decade because they were largely seeing record-breaking profit margins, which were being advanced by the environment. And the environment was an environment of low taxes and low borrowing costs, and in many cases cheap money and or free money. Both of those trends, unfortunately, have come to an end. We have the Biden tax hikes, which are hitting individuals as well as corporations, and they're scrambling to deal with those tax hikes. And the way they're going to deal with them, they're going to begin to lay off and cut costs because they don't believe they can grow as fast in the future as they could in the past with that type of environment. Smart money over at Credit Suisse believes that it's going to take at least 19 months for the downward revision of earnings to be flushed out of the economy. On that note, an average bear market or a recession of the S&P 500 will fall down at least 35%. We know that. And that occurs over a 14-month period. Now, we have currently fallen 23% up until this last Friday. That would be all the way back from January 2020's highs. And that means that all we have left to fall is another 12% further to go down. Now, of course, we're speculating that. So what companies are going to lead the way down and give us that final 12% drop? Well, there's a lot of people that believe that big tech and a lot of blue caps are going to give up that final 12%, because what they saw was that the small cap stocks were beat down sooner and faster and further and really got oversold. But a lot of the big tech and blue chip companies were actually going through distribution. That was the smart money slowly unwinding their position. And now it's time, as I've talked with you guys before, to push them through decline, to drive their price down, ultimately punishing the retail investors. And that's why we see companies like Google and Microsoft hitting their 52-week lows. And I pointed that out to you guys months ago, that we were going to see some of these beautiful companies that are great investments. We're going to begin to see a decline. They're going to hit their 200-week moving average. Some of them are 200-day moving average, and they're probably going to bounce. But we're absolutely in decline, and it's very likely those companies that are going to give up that final 12%, which could open up a monumental investment opportunity for so many people to get into some high-quality, high-grade investments at an extremely low price. And like I said, there's a lot of small caps that were oversold early on, and I don't think they're even going to go back to their June lows, because we saw even this last week that they didn't. A second very big indicator for the smart money is actually something called credit spreads. And I'm going to try to briefly explain it to you because it's actually super important. It's a very strong indicator that the smart money looks at. And credit spreads are between high yield corporate bonds and government bonds. And what they're looking for is that the yield offered for the corporate bonds needs to go up, because it needs to take into consideration the higher risk with owning corporate debt. And normally the smart money knows that credit spread has been achieved when there's a difference of at least 8% between government bonds and corporate bonds. And that's another thing that the smart money is going to be looking at before they take all that money and the profit that they took from those big blue chip companies that they've got sitting on the sideline. And after everything's declining, then they're just going to throw it back in. Smart money wants to see an improvement in new manufacturing orders. I explained that. They also want to see the price of copper begin to rise. Now, here's what's important for you to know about these things. It doesn't need to go all the way back to its all-time highs for smart money to buy. They just need to see that the downward trend has reversed. And so that's what they're looking for. They're going to look for that downward trend of copper prices to stop falling and to turn around. And that's going to be a big signal for them to put a lot of money back to work. They also want to see the profit forecasts of earnings to come down significantly, and they want to see that credit spread difference between corporate bonds and government bonds. And I know that's a lot to digest, but I'm just going to tell you this. The number one takeaway for most of you guys today is that those important factors are simply not in place yet, which means that the amount of money that's ultimately needed to dramatically push up the price of stocks isn't going to come back into the market until there's a justification for investment to be made. Now, on a quick note, Goldman Sachs cut their 2022 year-end target for the S&P 500 down to 3,600, which we were sitting at 3,670 when we went into the close on Friday. Now, that's a downward revision from 4,300, and that's a pretty significant drop. Now, UBS gave a year-end target for perspective at 4,000. That's a little bit more optimistic than Goldman Sachs, but I do have to admit that as I watch Goldman Sachs predictions, they tend to be more accurate. So how can we pinpoint for certain when all the pain is going to stop? One area of consideration is still going to be the U.S. midterm congressional elections. that could be a pivot for the markets to have a strong rally. A lot of people believe that the midterm will give us a rally for the last 2 months of the year because the catalyst is the idea that government will go into gridlock, which is perceived as bullish by the market. The opportunity for a pivot, at least another strong rally, could be motivated by that gridlock environment. Right now, we have an executive branch and a legislative branch that are on the same party, and what the market wants to see is for the government's hands to be tied, basically mean that they're not going to interfere with business and that the business can basically move faster and get them out of the way. I think the S&P 500 is giving us some pretty strong indicators, and I believe that once we officially break below 36.36, which we actually haven't seen yet because we need to break below and close below that price. That's extremely important for those who understand charting, which we haven't seen. And when we get that absolute confirmation to the next leg down, then we know that we're in a new phase of the bear market. And I want to break that down for you guys a little bit. What I mean by a new phase of the bear market is that we are going to begin to see more dramatic moves. So far, 9 times we've seen 10% moves up or down. And when we go into this next leg down, we're going to see potentially 20% moves, which are going to be so much more dramatic and ultimately can yield to a much higher opportunity for investing and swing trading. All of that depends if you have the right strategy in place. Now, you guys know that you can follow my strategy and, we can trade together. All you got to do is you got to hit that like, the subscribe, and that notification bell and follow along. I do give calls. You guys know that. If you're not on the MooMoo app, you can get the MooMoo app and you can also be in a community with me there. And MooMoo is being very generous. They have their best offer to date, which is 15 free stock for opening and funding an account. But if you just invest $100, then you're guaranteed 6 stock and 6 chances at stock valued at $2,000 each. But more importantly, you guys can find me on that app and you can chat with me there. You can find me by hitting the Discover tab and then the search glass and search Stocks with Josh, and we can chat some more there. In conclusion, if you're an investor, when we drop below 36.36 and close in the coming days, you guys can be rest assured that it actually may be a good time to do some dollar cost long-term investing. Not necessarily swing trading, not unless you know exactly what you're doing. Because we know this, that even though we're not at the exact bottom, we know that we are 25% down from the top, and we're only 10 to 12% to the bottom. And so it's basically a better risk to reward opportunity to begin to invest anywhere beneath 36.36. And you know that if you're a day trader, that when we fall into that deeper decline, we know that we're looking at more dramatic moves. So we can begin to see massive rips up and down in the range of 20% a number of times before this market ultimately settles down. You know that I'll be with you. You know that I'm going to give you the smart money indicators as well as my trades. You guys, I appreciate you staying connected with me. I'm looking forward to the videos I'm going to make for you this week. You know I love you. Have a restful weekend. Peace and blessings, my friends. I'll see you guys tomorrow.